I've been hearing people talk about this company, Main Street Capital, or Main, for a long time. And I saw that Brad Thomas here on Seeking Alpha wrote an article a few weeks ago on this company. And I thought, okay, it's time for me to really do a deep dive and really truly understand what this company does. And, just to really understand some of the pros and cons of this company, because something that you'll notice is that it is a BDC and it does have a very high dividend yield. And so, as somebody who retired off of his dividend portfolio, this is something that is very attractive. When you look at a company that's paid a dividend and never cut its dividend, this is something that catches a lot of dividend investors' attention. But yeah, if you're new to the channel, this is a new series that I created on the channel. Every single Thursday, I review Seeking Alpha articles like this. But yeah, let's take a look at the article. It's titled Main Street Capital, a Great Business at the Wrong Price. And like I said, it's written here by Brad Thomas. So the summary of the article is Main has seen significant share price growth and returns due to elevated interest rates and high yield dividends. The company operates as a business development company, or BDC, providing tailored debt and equity financing to lower middle market and middle market companies without incurring external advisory fees. Despite a well-covered dividend, Main Street Capital's current valuation suggests caution, with the stock trading at a 63% premium to book value. I am Brad Thomas, the author of REITs for Dummies. Yeah, Brad's very active here on Seeking Alpha. I've been following him for years. He starts out the article here with, sometimes everything seems to go right. In the case of Main Street Capital, ticker MAIN, that's certainly the case. Interest rates are elevated, providing significant income opportunities for this business development company, BDC. Despite elevated interest rates, the economy is still strong enough to support the interest payments that come with elevated rates. Thanks to the tailwinds, Main shareholders have been in a terrific place as its share price has gone into overdrive since the end of 2023. Including dividends, Main has returned 225% over the past 10 years. And you can see that here on the chart. Excluding dividends, it's returned just 48%. That's the power of high yield dividends. So dividends are absolutely part of the total return. You look at certain companies like Stocks, utilities, closed-ended funds, a lot of these investment vehicles, a big portion of the total return is the income. Even after this surge, the company has a monthly paying dividend yielding 6.1%, which excludes its special supplemental dividend. So it pays a monthly dividend, therefore a ton of dividend investors are going to be attracted to this company. There's not a lot of high quality monthly dividend stocks out there. Generally, that's just been the case since I've been investing. When I do research on monthly payers, a lot of them are not very good. Now, there are some exceptions. The exceptions can be very good. Just be very critical when you look at some of these investments that pay monthly. Oftentimes, they can have either high expense ratios, or, just you're sacrificing with quality. So just make sure that you're not just looking at, oh, it pays a monthly dividend, therefore it's a great investment. Okay. And also vice versa, just because it pays a monthly dividend doesn't mean that it's not a good investment. In this article, we'll assess how attractive this 4 billion market cap BDC is in light of economic challenges, opportunities, and its valuation. So a well-diversified BDC, Main Street Capital, was established in 2007 and operates as a principal investment firm offering tailored debt and equity financing to lower middle market and middle market companies. To be precise, the company is structured as a business development company, or BDC, under the Investment Company Act of 1940. And in the screenshot that Brad provided in the article, it writes here, highly regulated structure provides significant advantages and protections to our shareholders, including investment transparency, tax efficiency, and beneficial leverage. So moving on, in other words, the company provides financing for companies that usually do not have access to major bank financing. It does this without incurring external advisory fees, which certainly adds to its attractiveness. Most of its investments are focused on buyouts, recapitalization, growth, financing, refinancing, and acquisitions across a wide range of sectors. This covers companies with annual revenues between 10 million and 1.5 billion. Moreover, to add some complexity, the company operates several wholly owned investment funds, see below. These are categorized as taxable and structured subsidiaries. Taxable subsidiaries hold equity investments in pass-through entities, while structured subsidiaries are formed for financing purposes. This is probably one of the reasons when I first started learning about investing, this is a little bit more complicated. This is more complicated than selling Lay's potato chips and investing into, PepsiCo, right? Like this is, unless you studied finance or you understand the lingo, this can be a little bit intimidating for new investors. And so if you're going to invest into a company like Main Street Capital, I would highly encourage you to do your due diligence, truly understand what you're invested in, because this is not like investing into Coca-Cola. Okay, this is significantly different. And this is part of the reason why I've kind of shied away from companies like this, because I just don't understand them naturally like I understand Costco or, more CPG companies. All right. But if you do have a knack for, companies like this and understanding these type of businesses, you can have a competitive advantage because you understand the business. Okay. And so I guess to summarize here my thoughts, if you're going to invest into a company like this, take the time to truly understand what you're investing in. Don't just blindly invest into it because it pays a monthly dividend and it has a high dividend. Okay. And in the screenshot that he shared here, it's internally managed. Structure means no external management fees or expenses are paid, providing operating leverage to Main's business. Main targets total operating and administrative expenses at or less than 2% of assets. So I would assume this is its competitive advantage, is its ability to keep fees and costs low. And it's servicing a riskier business, part of the market. Small and mid-sized organizations, they carry a higher risk profile, which we'll get to here in a second in the article. Moving on, with that said, if there's one thing Main is known for, it's the dividend. The company has never cut its dividend and has grown its dividend by more than 120% since its IPO, keeping the payout steady even during tough times like the Great Financial Crisis and the pandemic. Currently, the company has an annualized monthly base yield of 6.1%. When adding its supplemental dividend, that number rises to almost 9%, but more on that later. Now, this supplemental income dividend, this is what interests me a lot about this company. It makes me think about Costco, right? If you own Costco, remember that special dividend that you got at the beginning of this year? That's kind of like what Main Street Capital does, but it sounds like they do it on a more regular basis. They've raised their dividend every single year since the Great Financial Crisis, which is very telling for its business. So having said all of this, as of the second quarter, the company's portfolio consists of 194 companies. The largest company accounts for 3.7% of total investment income and 3.3% of total portfolio value. I like that. That's very, very well diversified at face value from what I can see here. The average investment size with 20 million with a weighted average effective yield of just under 13%. Holy cow, 13% is a lot. But that's, like I said, right? This is a riskier profile, a riskier type of customer. And so therefore they're able to demand a much higher, yield. So roughly 44% of all transactions are recapitalization, refinancing deals, followed by leverage buyout, management buyout deals, accounting for a third of total deal volume. Slightly less than a fifth of invested capital was used for acquisitions. Only 4% of capital went toward growth projects. And you can see how well they're diversified geographically across the United States and through their business, their segments, right? Acquisition, growth, and recapitalization and refinancing. I think most new dividend investors, they're not going to truly understand acquisition, growth capital, recapitalization, all of these terms, unless you're in the finance world, it's difficult to understand really what's going on, right? You're not buying a Coca-Cola drink, right? You're not buying a Domino's pizza. This is not quite as tangible for your normal person. The lower middle market segment is especially attractive due to its relatively underserved nature and the potential for high returns. This segment accounts for 83 portfolio companies, covering 51% of the company's total investment portfolio. More than 99% of debt investments are first lien positions. 73% of debt investments earn fixed rate interest. According to the company, it has roughly 790 basis points net cash interest margins compared to matched fixed interest rates on SBIC debentures and notes payable. Adding to that, over the past 7 years, Main Street has strategically pivoted towards private loans. According to the company, this repositioning has led to significant growth in the private loan segment, which now accounts for 37% of total portfolio. That's up from 17% at the end of 2016. Private loans, whenever I hear private loans, I'd have to do some more digging. When I think of private loans, like, are they collateralized? Like, how are they collateralized? Like, private loans are inherently riskier than, for example, if you go get a private loan at a bank, what is the collateral, right? If you want to go do a home improvement, what's the collateral for the loan? If you get a mortgage, well, the house is the collateral. If you get a car loan, the car is collateral. So I'm curious with these private loans. When I see private loans, it kind of makes me, okay, what's going on there? And with all of this in mind, let's dig a bit deeper. A well-covered dividend in an increasingly tough environment. Main Street Capital continues to do well. In the recently released second quarter, the company reported a solid increase in total investment income, which rose $132 million. This translates to a 3.6 year-over-year growth rate, as we can see in the overview below. This is from their quarterly report. You can see here that this company is not growing by double digits year over year. This is a slow grower. This is going to slightly outpace inflation from what it looks like. Okay. And according to the company, this uptick was mainly driven by strong returns from the lower middle market, private loan investment portfolios, and the asset management business. To be more specific, interest income saw a $2.8 million increase compared to the previous year, while dividend income grew by 4.3% year over year. Meanwhile, the company's net asset value per share reached a record of $29.80 at the end of the second quarter, which marks a 7.6% year over year increase. And so far, so good. Unfortunately, there's some bad news. Despite the good news so far, the company saw an increase in operating expenses by $3 million from the previous year, mainly due to rising interest expenses, share-based compensation, and general administrative costs. Additionally, and even more importantly, the rise in investments on non-accruals, which now account for about 1.2% of total investment portfolio at fair value, suggests challenges with certain underperforming investments. Total non-accrual investments represent 3.6% of the company's investment at cost. According to the company, this is mainly caused by companies with a focus on consumer markets, an area with increasing problems. I wonder if that has to do with their private loans, because when we talk about consumers and private loans, they're increasing the amount of private loans as a percentage of their total revenues. I would have to do a little bit more digging before I pull the trigger, just to kind of understand more about those private loans. Moving on, going into this year, total investments on non-accrual status accounted for 0.6% of its investment portfolio. While 1.2% is not a horrible number, the trend is in the wrong direction. Moreover, the company has consistently hinted at weakness in the consumer market, which means nobody was surprised when the latest numbers hit the wire. Nonetheless, using JP Morgan's data, we see that small cap companies, the closest comparison to Main Street's target market, have below average interest coverage ratios. 40% of small cap companies are unprofitable, the highest number ever outside of a recession. So he shows some graphs here that, comparing small cap, mid cap, and large cap. Now you have to understand this is a riskier profile. Microsoft or some of these large companies that have good credit ratings, they're not going to settle for a 12% interest rate. Okay, this is what these companies, these smaller companies, mid companies, are what they call them. These small companies are paying Main Street Capital, over 12% interest. And so it's just important to understand that, Main Street Capital is servicing a part of the market that is riskier, but they're demanding and charging a higher rate in return. So it kind of balances the risk reward profile there, but it's something to understand that you're not getting the highest credit rating companies. Okay, so it's just important that you understand that. The good news is that the dividend is safe. So far, the company has never cut its dividend. As we have already briefly discussed, that's unlikely to change soon. In the first half of this year, total distributable net investment income, or DNII, rose by 6% to almost $190 million. In the second quarter, the company reported a DNII per share of $1.07. As we can see in the income statement above, this was down slightly compared to the second quarter of last year and Q1 of this year. Main Street Capital explained that this decline is largely driven by reoccurring factors, including dividends from equity investments and accelerated repayment on repricing activities related to debt investments. On a trailing 12-month basis, DNII, so the distributable net investment income, has increased almost 90% since 2020. So it's not too shabby. The slight DNII decline also did not keep the company from distributing a special dividend. The total dividends paid in the second quarter were $1.02 per share, 95% total payout ratio. Yikes, 95% is high. This included a supplemental dividend of 30 cents per share and represents a 13% increase compared to the same period last year. It also translates to a total annualized yield of 8.4%. So with the special dividend or the supplemental dividend, it increased its overall yield by over 2%. Even better, the company's board also approved a special dividend of 30 cents per share for September, as it expects at least $1.07 in DNII in the third quarter. As we can see below, the special dividend remains a key tool for the company to reward its shareholders. Now, this is actually really cool. So the special dividend is what attracts me with this company. Even though the payout ratio is high, they're being more conservative with keeping their base dividend low because they don't want to cut their dividend. If they end up going into rough times and they cut their dividend, their stock will be punished, right? And they're obviously striving for dividend aristocrat status, and they know their shareholder base. They know that their shareholders invest in this company for the dividend. They pay a dividend monthly for a reason, and this is a clear focus. And as a dividend investor, I like this. I like it when a company's management is focused on its core base, its investor base, which is income investors. The special dividend allows the company to maintain a higher dividend yield, but if we go into a massive recession, they have some wiggle room. And I actually really, really like that. That's another reason why I really like Costco. Costco is so great. They have their dividend so low, but I think the dividend yield is like 0.5%. But with the special dividend this year, it equaled out to be almost 3%. And that's why I will never say never. I never intend to sell my Costco shares, even though the forward yield is low. I love those special dividends. And it's just an interesting way for a company to be a little bit more conservative with the yield, because they know if they cut their dividend, their stock is going to go in the dumpster. This is really a smart move, in my opinion. Moving on, then there's the valuation. Main Street Capital has a history of trading above its book value. Some BDCs trade discounted. The difference is often due to trust in management and or quality of assets. After all, if my book mainly consists of super risky loans, investors won't pay a premium for my equity. If I have a pristine track record like Main Street Capital, investors happily pay a premium. In this case, Main trades 63% above its book value. That's not unreasonable. However, it also isn't a great value in light of economic challenges. While Main deserves a premium, the current risk reward is far from great. as we could see a further deterioration in credit quality potentially followed by rate cuts. This is reflected in analyst expectations as well, as the current consensus price target is $49.50 above the current price. Although we wouldn't go with a sell rating here, Maine is a hold at current ratings, providing a much better risk reward on a 10 to 15% correction. This is quite common if we look at the company's history of stock price declines. In general, however, at the right price, Maine is an income vehicle that is very difficult to beat. In closing, Main Street Capital is an exceptional business benefiting from the current economic environment. Elevated interest rates have fueled impressive returns for shareholders with a 225% total return over the past decade, mainly driven by its high-yield dividend. Meanwhile, the company's diverse investment portfolio and strong dividend track record make it an attractive income-generating asset. However, despite its strengths, the stock's current valuation suggests caution. Trading at 63% premium to book value, Maine may not offer the best risk reward at these levels, especially in light of the increasing pressure on profitability and credit quality of small companies. While the dividend remains safe, waiting for a pullback could provide a more favorable entry point for long-term investors. Well, that's the article here. Let's take a look at some of the comments and then we'll wrap it up. The first comment here is, I've been long Maine for at least 8 years and probably longer, and have always been reinvesting the dividends up until the middle of last year to start building up some cash. My yield on cost is over 16%, and I doubt that would be much different today if I had waited for the ideal price to pick up my first shares. My recommendation for anyone who is looking at picking up Maine is to start a small position at today's price so it has a spot in your portfolio, reinvest the dividends, and then pick up additional shares over time. 10 years from now, you'll be glad you did, and if you didn't, you'll be kicking yourself for waiting. As good companies like Maine are rarely at a discount, but can always be counted on to be a good asset to have in your portfolio. So I do agree with what this person is saying here. You don't want to always just sit on the sidelines and wait. My dad has been sitting in cash since the great financial crisis. And no joke. I mean, he still has, money invested, but a large percentage of the money that he, inherited with the passing of his mom, my grandma, he's held a lot of that money in cash. And I got him to talk about it once, and he ultimately said that he was just scared. He let his emotions get the best of him. And so anything that you can do to manipulate your emotions, right? Because investing, it's really emotional. And so I really like what this person is saying. To get over the hump, maybe you invest a small amount today, and then you reinvest the dividends and you dollar cost average. And as it goes down, you then kind of add more. Because if you would have said, oh, I'm not going to, invest, because the market's at all-time highs or we're just about to hit a recession, the simple answer is you just never know. And so I'm not saying go and invest all of your money today. But what I'm saying is I much prefer to focus on time in the market than timing the market, because you just never know. And I like what he says here, so you don't kick yourself because you've been waiting on the sidelines. And that's so true. Another comment here, having spent the bulk of my career at Costco, speaking of Costco, I've talked about them a couple of times, I think I'm pretty good at recognizing well-managed companies. I have invested in OTTR, TFC, OGE, EPR, and others, and have had few regrets. Maine is my favorite, having invested in 2011 and then 2 subsequent purchases and no more than $34. They appear to research their investments carefully and also involved in the companies that they invest in. I doubt that the non-accruals were caused by inaction at Maine. Every article I read in here is critical at the 60% plus premium over NAV. If it sold at NAV, the dividend rate would be around 15%, including the quarterlies. This is a dividend that has a pretty good track record, and you won't find that rate anywhere without a high degree of risk. They remind me of a small version of Costco at a more reasonable entry point. I like this comment. I like that he compares it to Costco in the sense of, good management. A management can, either make or break a company. I don't personally just invest into a stock solely because of the management, because the management can too easily change, right? One year to the next, the management can completely change, the board can change. And I don't like to invest like that, but I do like the reassurance that the companies that I'm investing in, that they are well managed. And, Costco, as an example, has a reputation for being very shareholder, employee friendly, vendor friendly. And so having that reputation as a business is so great. And I can't remember where I saw this, but I saw that, companies that have the best places to work rating, that they have outperformed the S&P 500 year over year since that rating was established, the best places to work. Those companies, if you're a stock picker, go take a look at that list of companies that are ranked high on the best places to work. Because generally, when a company takes care of its employees, they take care of their customers, they delight their customers, and what happens? Capitalism flows. It works beautifully. They flourish and everyone wins. And as a shareholder, you profit from that. And so good business is good. Another comment here, great review and very eye-opening for many. I've been waiting for it to be a more logical price and hold on to other BDCs without regret. ARCC is my number one. Best as always, and happy investing, Rose. I've heard a lot of great things from ARCC as well. Another comment here, love the specials. They're even better than getting an extra monthly every single quarter. I absolutely agree. It is so great when you see that special dividend hit your account because it's not expected. I love the idea of under promise and over deliver. And it sounds like Main Street Capital is really taking that to heart, the under promise and over deliver. So that's the article. All in all, I would give this article an A-. I really liked the fact that, Brad took the time to actually explain what the company does, because like I said, I don't know much about this business. And so I was really hoping that he would discuss the different business units, where they're generating their revenue, what segments contribute to what. And I thought Brad did a really great job when it comes to outlining the business, looking at their performance here quarter over quarter these last couple of years. What I would have liked to see. Now, this is one of the critiques that I have. This is not unique to Brad, but what I don't like is the statement around the dividend has done well in the past, therefore we can only assume that it will continue to do well in the future. Now, he didn't explicitly say it like that. He did mention some of the risks, some of the tailwinds, and some of the things there that it's maybe temporary, but I don't like the fact that anyone, and not just Brad, anyone saying that the dividend has done well in the past, therefore it will continue to do well in the future. I just don't like that statement as a whole. I try to be a little bit more conservative because I've been burned too many dang times. Well, let me just give you an example. So speaking of Brad last year, not to pick on him, but last year, right before MPW cut its dividend, Brad came out with an article very bullish on MPW. And what happened to MPW? They cut their dividend. Just because a dividend, and he referenced in the article, they've been paying a dividend for X amount of years, therefore we don't see why things should change, therefore we're bullish, right? Like, I just don't like it when, and I try not to do this myself, just because a dividend has been increased year over year in the past, it doesn't mean that it will continue. In the case of Main Street Capital, I do really, really like their track record. As a financial institution, the fact that they didn't cut their dividend in 08-09 is so telling. The fact that they didn't cut their dividend during the pandemic, so telling. The fact that they didn't cut their dividend during the rate hikes in 2018, so telling. I think this is a company that, especially with their special dividend, that gives them a lot of flexibility. I am really interested in this company. I don't currently own this company. If I was still working my day job and had more money to invest, I would consider adding a position to this. This is another one similar to, kind of FDVV that I shared on the channel a few weeks ago. If I were to sell out of another company like Honeywell, I'm kind of considering Honeywell. I'm probably not going to sell it, but if I were to sell one of my shares, I would consider one of two things. I would either look to add a new position, one that meets my goals. If I'm looking for income, I would look to add something like this that has a higher than average dividend yield. Or if I'm looking for growth, I would add, one that has a higher dividend growth rate. Or I would just throw it into SHD, DJRO, or JEPQ, right? Those are kind of the things that I kind of bounce back and forth with. Well, what do I want to do? What what makes the most sense. I try to minimize and declutter my life. And so I don't want to just add another Pokemon to my arsenal just because I like the Pokemon card. Like, you got to catch them all. But like, there's a lot of great companies out there. If I was looking to retire in the very near future, I would definitely consider owning a company like Main Street Capital. But like I said, this is not a company that I would blindly invest in. I mentioned this a little bit earlier in the video. I would do a little bit more digging to understand this company a little bit more so that you fully understand what you're investing in, because this is not like investing in a Johnson & Johnson or Coca-Cola. Okay, it's very, very different. But yeah, that's the video. I'd love to hear what your thoughts are of Main Street Capital. Do you invest into this company? Would you recommend it? What are your thoughts on it? And yeah, as always, everybody, I'll see everybody in next week's video on Thursday and in my regular videos here on Sunday. Thank you so much for watching.